What's going on, guys? Welcome back to another video. In this one, I'm going to be preparing you guys for everything that you guys need to know going into the Jackson Hole Symposium tomorrow with Powell. He's going to be speaking at 10 a.m. Eastern, which obviously we're going to be streaming on this YouTube channel here like we do every single day. But I also want to tie in this broader issue that the United States economy has been witnessing really ever since I've been alive, and most likely long before that, and how it's becoming more and more important, especially when we get into this potentially declining interest rate environment that everybody is expecting to start to occur this September. So guys, without further ado, let's get into all of this information. Remember, these YouTube videos are back every single day, so make sure you guys have notifications turned on for the channel so you don't miss any of these. And as always, if you guys wouldn't mind going down, hitting that like button, costs you nothing to do it, helps me out a whole lot, spreading this information out to as many people who actually want to learn. So let's get into it here. So the first thing that we really need to focus on is obviously the national debt. Meanwhile, nothing is stopping this train. U.S. debt up $38 billion yesterday to a record $35.26 trillion. We're back to adding about $1 trillion every 90 days. Now, we could probably do a whole webinar series on the debasement of our currency and all of the different problems associated with that, which we're probably going to in the Discord with the webinar series that we're going to do in there. The Discord will be out next week for you guys, so I know all of you guys have been asking in the comments and DMing me when it's going to be ready. Next week, guys. All of you guys that are already in the courses are going to get first access. Again, all of you guys get it for free, and then everybody else is going to be able to hop in after. But as we can see over here, U.S. national debt at $35 trillion. And if you guys have been paying attention, this is where things start to get really important. The United States over this past year has had to roll over, refinance about $7.6 trillion of government debt, meaning that older bonds have come due. They need to pay back those bonds, so they need to sell more debt and then basically pay off their existing debt with a credit card. It's effectively what they're doing. Now, this becomes more increasingly difficult when we are in a period of hot inflation, which we had been over the last really 3.5 years here. So when the Federal Reserve comes out and raises interest rates aggressively, which they did, in order to get inflation under control, they run the risk of effectively bankrupting the Treasury. Now, again, if the Fed really wanted to get inflation under control, well, remember, the cumulative effect on prices since we really started to see inflation moving to the upside is between about 20 and 25% increase across the board on an average basis. So if the Fed really wanted to get inflation back under control earlier, well, they would not have left rates at 5.25 to 5.5%. They would have gone a lot higher, but they can't because the Treasury still needs to be able to sell these bonds at manageable interest rates so they don't have to do one of the worst things that we could possibly witness, which would be to inflate the debt away, print more currency in order to pay the existing debt, which effectively they do right now through a couple of different avenues, but it could get a lot worse. Now, here's the second scenario here. Remember, we have all this debt outstanding that we have to pay back, and we're probably going to do some sustained money printing for a significant amount of time in order to do that, as well as selling a bunch of these bonds, which is one of the reasons why we paid so much attention to these bond auctions recently. Now, when we are going into tomorrow with the Jackson Hole Symposium, which obviously we're going to talk a little bit about more later in this video, the market is obviously going to be looking for some guidance from Jerome Powell as to what he is expecting to do come the September FOMC meeting. Now, if we start to drastically decrease interest rates, we've already talked a lot about how that is going to weaken the dollar and potentially cause a further unwind of the carry trade, causing U.S. equities to come down. People would go out and sell bonds in order to take their money out of the U.S. markets and go repay those loans that they took out in Japan. But what's also really important is the risk that prices, not necessarily, again, there always is a risk that inflation starts moving back to the upside, but there is a risk that inflation stays where it is, at around this 2.9 to 3% area, which I've said a lot is probably where we're going to end up. And what the Fed has said a lot is, well, we don't necessarily have to wait for inflation to get to our target of 2%. We can start backing off a little bit earlier, which is exactly what it looks like they are about to start doing. But think about it like this. who benefits from inflation remaining a little bit higher and the dollar devaluing? Well, obviously asset holders, and we've seen this happen throughout the year. Let me pull this up over here. Inflation, the assets that can benefit significantly from inflation, specifically gold here, has hit all-time highs and has continuously moved up throughout this year, about 19.83%. So asset holders in general are going to benefit. Who's going to get hurt? Well, people who don't own assets. So the lower class Americans, the middle class Americans who may not own enough assets, those people are going to continuously get hurt as inflation remains high, and it becomes even more difficult for them to get ahead because things are more expensive, so they have less discretionary income on a real basis, effectively inflation adjusted. But who else benefits? Well, the Treasury. If the dollar starts to weaken even more, it makes it a lot easier for them to pay these interest payments. So it's kind of in the Fed and the Treasury's best interest right now to start backing off on their rights right now so that they can sell new debt at lower interest rates. And it also makes it easier for them to pay off their existing debt at some of these higher interest rates. Now, the Treasury has already taken steps to try and make this issue a little bit kind of better for them. In the last QRA, the quarterly refunding announcement, they did announce those bond buybacks. Now, while that's not going to be something that's going to move the needle here, it is something that they are trying to do. Just think about it like this. If they sold bonds at, let's say, a value of 100, and now interest rates have gone up, well, obviously interest rates and bond values are inversely correlated, so they could go out and buy those bonds back at a discount. It's effectively a short sale. You could think of it like a short sale where they're selling something and buying it back for cheaper. But this is the issue that we have right now, and it almost results in the same thing, which means inflation would be higher for longer, which is not great. It's not a good environment that we are in right now. People might look at the markets and be like, oh, look, markets are at all-time highs. And yes, they can continue going up, and in inflationary environments, they probably will. But the middle class, lower class people who are really supporting this economy are going to continue to get hurt, which is a very difficult problem to solve. Now, let's talk a little bit about what to expect at Jackson Hole tomorrow with Powell. So obviously he's going to be taking the stage at 10 a.m. The speech is broadly expected to shed light on the central bank's game plan ahead of its expected interest rates cuts. Minutes released Wednesday from the rate-setting FOMC at the July meeting revealed a vast majority of U.S. policymakers expect to cut rates beginning at the group's September summit, the first time since March 2020. And we have seen a lot of volatility in these markets where people are betting on what they expect the federal funds rate to be by the end of the year. These have shifted back from where we were seeing them at yesterday. 29% probability that we were going to cut rates by 125 basis points by the end of the year. These have shifted back a little bit. So we're sitting right now between about 75 basis points of cuts and 100 basis points of cuts. If the overwhelming expectation is in line with the Fed's expectation, which we don't know yet, that's kind of what we're looking to see tomorrow, then that would mean that we should expect a 50 basis point cut at the September meeting, because there's only 3 meetings left. In order to get 100 basis points of cuts, they would need to do a 50, a 25, and then a 25. Now, if Powell tomorrow comes out and effectively does his usual spiel of, well, we don't really know, we're going to be data dependent, we expect to start cutting rates in September, but we don't necessarily know by how much yet, that could easily spook markets a little bit. We would see yields move to the upside, the dollar would move to the upside, which again is something we were talking about on stream today. And we could expect to see equity markets, the S&P, NASDAQ, any publicly traded stocks starting to trade a little bit lower. Now, it's probably not going to be the craziest event in the world. And what a lot of people have expected is Powell to come out is very, very, very dovish and say, yes, we are ready to cut rates. The data looks good enough for us to do it. And he's probably not going to do that until it's actually time to start cutting. The other thing we have to think about here as well is history. Has the Fed ever come out and cut rates when the market was within like 2% of its all-time high? No. Could they? They could, but it would be pretty unlikely for that to happen. So quickly, before we wrap it up here, let's go over a couple of scenarios in which we would see the market starting to sell off and give us a little bit more confidence that we could see some more significant rate cuts. Well, we could see the further unwind of the carry trade. We could see even more bad jobs data. We could see inflation of the CPI data really moving to the downside, which again, drastic movements in these data points is going to be what's important. If they come out at expectations, well, then all of these different metrics that we're looking at to gauge interest rate expectations aren't really going to change because the data came out as expected. It's drastic changes in either direction is what we have to look out for. Now, tomorrow, what are we really listening for out of Powell? His tone, how he feels kind of about the labor market, which he could talk about in his speech there, and also what he thinks about inflation. But again, we really have to see what he ends up saying to give us that understanding of where markets are likely to head next. We understand the debt issue. We understand that inflation is probably going to be a little bit higher than what everybody has been used to over the last 20 years. And that is going to come with a very different market, I think, than what people have been used to. But that is why I'm here. We navigate the markets together and we continue to have success. So team, that's going to wrap it up for this one. If you guys did enjoy this video here, make sure you guys drop a like down below. I'll see you guys in the live stream tomorrow morning. Other than that, peace.